Hello everyone and welcome back. Now, I'm very excited today because we're going to be taking a look at the oldest ETF in the world. It's been running since 1999 and I'm still classifying it as a buy to break down and spoil the video. I think that this is still a very good investment. It has a massive assets under management and is traded regularly, so it's excellent for buy and hold investors, and it's excellent for anybody who's looking to run theta gang strategies or what have you. Let's dive right in and take a look at this puppy. So, as I make my way down into the corner in my regular spot down here, the iShares S&P TSX 60 Index ETF. So, we're always going to start off on the fund website itself. We're going to let the fund speak for itself and see what they have to say. So, why XIU? Exposure to large, established Canadian companies, one of the largest and most liquid ETFs in Canada, started trading in 1990, making it the first ETF in the world. Yeah, if we look down at the inception date, it's going to say 1999 right down there. But yes, this was the very first ETF ever created in the world. Pretty cool, actually. It's a small piece of history. I think that even if you don't view this as an investment vehicle, if you are a collector of investment items, that this is still one that's pretty cool to have inside your collection. At least one share, to say the least. Especially if you can get in at a good price. But that goes without saying. Let's continue. So, investment objective seeks long-term capital growth by replicating the performance of the S&P TSX 60 Index net of expenses. Perfect, so we're looking at long-term growth. Now, and we see, as it's done over the past 10 years, a very respectable 8% solidly, 11.44 in the past 5 years, over 10% over the past 3. Very, very solid returns. Now, these are going to be the largest companies in Canada, so we can expect them to be very, very stable and with large barriers to entry in their market. Now, here we are in the distribution section. Now, this is not a dividend fund itself. However, it does hold a lot of dividend-paying companies. It currently has a dividend of over 3%, which not bad, certainly not terrible as far as growth funds go, and for a mix between dividend investors for those people who really dislike selling things. And I just wanted to go through the history and see the cash amount. Now, it does pay out quarterly, but we can see that solidly there have been around the 25-cent mark, and if we go back historically into 2021, we see that it has been increasing. Now, this is probably because the constituents of the index are very high dividend payers, as we will see. A lot of them are in the past, but that is more indicative of Canada as a whole. Canada is really heavy into our own infrastructure stocks, as well as we have strong financials and pipelines. So both of those are going to be heavy dividend payers. And as we can see, boom, even going back, now this index has changed its composition quite a bit. Even as what I just said, with Canada being pretty strong into those sectors, it has changed its holdings around consistently. But we see, going back to 2012, you were making 10 cents there. If you had been holding all the way up to 2020, you'd have doubled your 19 cents, 20 cents. So you would have had double the amount of income, or double the amount of dividends coming in every month just by holding the same fund, as well as that massive capital appreciation along the way. This is an excellent fund for very passive, hands-off investors who just want to buy something which is going to last a long time. So let's go down to the key facts. I want to point out net assets. This one's massive. Has $12 billion of assets under management. Crazy. I think this is the largest ETF in Canada. It has to be. Number of holdings, 61. Yeah, TSX 60, so we'd expect there to be 60 holdings, maybe a little cash inside there as well. There we go, 12-month trailing yield of over 3%. Certainly nothing to laugh at as an investment vehicle. Sustainable characteristics, we're going to jump right past that, as well as the business involvement, certainly not necessary for down here. Now, the fees. Now, interestingly enough, so this has a management expense ratio of 18 basis points. I'd put this as very, very low, very, very affordable. To note, though, there is a maximum annual other expense of maximum of 2 basis points. So it's not really at 18, it's 20 basis points, which puts it up there with a lot of other funds which have quarterly trading, I'd say, as well. So it's not the cheapest out there, but it is a very, very, very low cost. One of the reasons why I am so attracted to this. And a risk rating of medium. Should never be anything less than medium when we're holding common stocks. All right, now let's take a look at those common holdings. Or excuse me, the top 10 holdings. Actually, we'll take a look at all the holdings. We'll just go through a little bit. So right off the bat, we can see top of the list and very heavily weighted Royal Bank of Canada coming in at 7.5%. Everybody in Canada knows the Royal Bank of Canada. They are everywhere, and they are the largest company. Toronto Dominion following in second place with just over 6%. Now, TD is another massive bank in Canada. They have tons of American exposure, and they are a solid investment. They're a very long-running bank. All 6 banks have been running around for a long time, but TD is a good investment and is one of the few banks that I actually hold just as an asset outside of itself. Now, Shopify is a massive e-commerce giant located out of Ottawa, Ontario, and I'm not too familiar with the company itself, to be honest with you, and I've never used it. However, it's a strong investment and has been supporting our tech sector. Basically, that's it. That's all there is Shopify and nothing else. Moving down the list, we see Enbridge. Enbridge is a massive midstream and pipeline. Now, I don't think this was in the top 10 of holdings of the index originally. Enbridge has grown quite a bit over the past 20 years. And if you look back over the composition of this index, you can see that it's changed quite a bit. But yeah, Enbridge is about the 3rd largest company in Canada right now, and they are a healthy dividend payer and have had solid returns over the past. They're quite necessary for so that a lot of homes in the country and a lot of businesses can get their natural gas and their heating. They're kind of necessary. Then we have 2 railways. So we got Canadian Pacific Kansas and Canadian National Railway. So very, very strong infrastructure stocks. They've been around forever. Following down, Bank of Montreal, our 3rd bank on the list. BMO has been around forever. They have a very strong global asset management side to their business, and they've done quite well as well. Canadian Natural Resources. Finally, we have another energy. This is our actual producer. Brookfield. Brookfield's more of an investment company. Once again, Canada's very strongly known for its financials and the regulations that we have for them. And then Bank of Nova Scotia. This is a very old, I think it's the oldest dividend-paying bank out there, but they've been paying their dividends for well over 100 years, and Bank of Nova Scotia really has strong vicissitudes to the market, where they peak at high rates and they dip quite a bit. They're paying a very high dividend right now, well over 6%. And I honestly, the way that they're structured and the way that they're built up, I don't see them going anywhere. They also have a very strong presence in Latin America, and they're broadening outreach as well. All right, so over here into the top 20 holdings, I just wanted to go through here because I'm not too familiar actually with Constellation or Alimentation, but we see CIBC, that's going to be number 13th on the list. Suncor, who owns Petro-Canada, right down there, another energy producer. Waste Connections, infrastructure, that ain't going anywhere. And then Manulife and Sun Life. I was kind of surprised to see how low these 2 were on the list, as they are extremely strong life companies and they're extremely quality companies. However, yeah, they're definitely part of the index. We have Bell Canada making up the communications. Bell Canada is a massive company and is one of the 3 major communication companies in Canada. And then Intact Financial, another financial to round it out. As we see the actual breakdown, we have a very strong distribution across the board. So financials are only at 34%, which is high, don't get me wrong, for any index really. However, Canada is so strong inside of its financials, and looking at the holdings we've had, they're all quality. They're decent companies which have been paying out for a long time. They're not really going anywhere, at least not anywhere fast. Energy, we see that coming in at 17%, which is refreshingly low, actually. We see a lot more. Sometimes when you're looking at a lot of Canadian funds, they'll have 30% in financials, 30% in energy, and everything else is just mixing it up. However, this is much more selective in that, and I like that. Very good diversification, and for passive hands-off investors, exactly what you were looking for. Industrials, IT, it's basically going to be Shopify at that point, making up 10% of the index. But then communications, refreshingly low, and utilities, refreshingly low as well. For a lot of dividend investors, people looking at the Canadian economy, they're going to have a lot of utility companies inside of there, so it's refreshingly low. And finally, real estate. I want to go down and see exactly what that is for 0.7%. It's probably going to be a Canadian apartments, or it's going to be a REIT of some sort. Oh, please. Real estate. Yeah, Canadian Apartments REIT. As well as First Service Subordinate. I guess that's where that little bit comes up. 0.6. Oh, 0.7%. That makes sense. 0.38 plus 0.32. That gives us 0.7. So that's where all the real estate comes from. Now, these are both very, very large companies, and they've been in service for quite some time. Ooh, Algonquin Power. They have not been performing well recently, and makes sense why they have dropped so far down the list. Finally, let's go through the ETF facts together. Now, sometimes a lot of these funds will hide trading expense ratios inside of here. However, I'm very happy to present that no, there is no extra trading expense ratio. They put that 0.2 basis or 2 basis points on right on the front page. It does to say that there might be some extra charges up front. Now, we've talked a lot about the TSX 60. Now we've taken a look at the index, its dividends. Let's take a look at how a stock actually makes it into the index. So here we have, right off of the S&P Dow Jones indices, how they choose their methodology for what makes it into the S&P TSX 60. Let's read through it together. So the S&P TSX 60 is a subset of the S&P TSX Composite. It has 60 constituents and represents Canada's large cap securities with a view to reflecting the sector balance of the S&P TSX Composite. In using trading data to determine any matter relating to the S&P TSX 60, including index composition and calculations, the trading data on TSX and US exchanges is reviewed. Okay, what does that mean in real, just plain English? So essentially, we want to take only large cap Canadian companies. We want to make sure that they are extremely liquid and extremely tradable, so that there is high interest in the market. And we want to then take this index and then market cap weight it to approximately what the Canadian composite would be. So kind of balance it out so that not anything is overrepresented. Certainly would explain why we see financials and energy coming in at respectable amounts instead of overbearing the index, as well as why we have information technology inside of there, the Shopify being so high. Makes a lot of sense. This is a very solid index, and it has persisted for coming up over 25 years at this point. Almost 25 years. Yeah, almost 25 years at this point since BlackRock's been running it, and it has performed quite well. Speaking of, let's take a look at those performance returns right now. So I have put XIU up against some competitors. Now, it's going to be, this is because it is such a long-running fund, we're only going to be taking a look at 2 competitors against it right now. That's going to be, I should actually add one more in there. Nope, perfect, we're good. So, which is the XIC, which is the Canadian Total Market Index, and XMD, which is the Completion Index. So essentially that's, instead of doing large caps, what if you wanted to invest in mid and small caps instead? Let's just take a look and see how those have performed. Some of these funds down here are much younger. We'll get into them in a bit, but let's start off with those 3 comparisons, which have been very long running. So let's take it back to when you could actually invest in them, back to 2001. When a lot of them started. Oh my goodness. Actually, let's kick it up to 2002. I know that both of these funds had started by then, so we can see how the returns. And we can see that XIU, the S&P TSX 60, has outperformed the complete total market index and has very strongly, that's too strong. It has moderately outperformed the mid and small caps. So that makes sense that XIC, the total market, would be in the middle because the large caps are pulling out on top and the mid and the small caps are pulling out behind. All right. Now the next fund that we're going to take a look at is XEI, which is a very popular dividend fund. Very broad-based and well-focused dividend payers of the Canadian economy, but it didn't start until 2007. So as we inch our way closer towards that date, we're going to see that XIU, the large caps, have pulled out on top. They are a consistent winner, and that the mid and small cap funds have underperformed. $2005, boom. Yeah, as we inch closer to the date with less time going on, we can see that there is a greater change in the dispersion of outcomes. So this is why choosing the correct fund is so important. All right, we're almost there. See that XMD, the mid caps, are already being taken over by some other funds there. All right, let's move up to 2007 so that we can, actually let's move up to 2008. Now we can include XEI into our calculations. So we can see we've got, I guess I should take VDY. VDY was one of my winners for the Canadian dividend funds, as it's performed excellently. However, it didn't start until 2012. So at almost end of 2012, beginning of 2013. So we still can't compare it. In fact, let's get rid of all these ones out there who are a little bit younger. XDIV, they are great comparisons and they're great to show the returns against. However, they just haven't been running long enough. Okay, so here we are in 2008, and I want to say XCS can go as well. So here we are looking just at Canadian small cap index. So we have the mid and the small cap, and we have the small caps, and we see that XIU coming out very well on top. XIC, the total market index, just from these specific returns, has been the winner, but XEI under it, the mid caps and small caps, running far behind it. So here we are looking at January. This is kind of a reset actually from the great financial crisis. It's interesting that after the great financial crisis happened and we entered a new investing environment, that small caps have not performed nearly as well. We're seeing a much more stratification of returns. We're seeing that a lot of, especially since the 2020, and we'll take a look at it then. However, a lot of these returns have all gone to large cap companies, and the market is not nearly as balanced as it used to be anymore. Let's take a look back up to 2010. So now we're looking at 12 years of returns from these funds, and we can see that, boom, XIU and XIC, either one of those puppies would have done exceedingly well. XM, in comparison to the mid and small cap, dividends, and especially the small cap stocks out there. I guess that small cap didn't start until 2011. It's unfair to give that returns, otherwise it still has solidly underperformed though. Alright, yeah, it still has solidly underperformed. We can expect to see exactly what we're seeing. Large caps pulling ahead, the all cap index, the total market index I should say, being somewhere in the middle there. Dividends coming in a third place, as dividends have performed solidly over that time period, and a lot of dividend pairs or heavy dividend pairs are going to be large caps as well, so it makes sense why there's a lot of crossover between the two. But mid and small caps falling far behind. Okay, finally we're up to January 2013, and we can add in another fund, the Vanguard Dividend Fund. This is one that I like quite a bit. It is going to hold slightly fewer holdings, however they are strong dividend payers, and we can see that one has solidly outperformed XEI. Now I put as Vanguard's dividend fund, VDY, as one of my top funds in Canada, particularly for dividend investors and anyone looking for capital appreciation. So I like to have this as a comparison against. Vanguard does good work. We kicked this up 2015. Now there was a little bit of fluctuation around interest rates, and as we can see, yeah, you're definitely better off holding either the Vanguard Dividend Fund or that S&P TSX 60. Solid outperformance over the total market, and especially over mid, small cap, and that XEI. I really just like throwing this up here to show that XEI has underperformed a number of other investments, and that dividends themselves are not an indicator of a company performing well in the long run. They are indicators of other things, particularly a company's dedication to returning its profit to shareholders, but it is certainly not the only thing to look at. Speaking of, let's move it up another couple of years. If we move this up to 2018, let's see how everything's performed here across. Again, we're seeing, okay, BDY and XIU basically tied, XIC, XEI underneath that, mid and small caps, and then small caps underperforming as well. Really no surprise at this point, we're seeing the same thing happen over and over and over and over again. Now at this point, I would love to put in ZWC as well, just to show how these returns have compounded over time. This is an extremely popular fund, ZWC. It is the BMO Canadian High Dividend Covered Call Fund. So it has over $1.5 billion under assets under management, and they write covered calls on some of the largest Canadian dividend payers out there. And as we can see, going back, I want to say that this fund started around the same time, but it has solidly underperformed. Those covered calls and the high expenses of the fund have killed the returns over the long period. Let's kick this up to 2019. See how things are going here, and boom. XIU coming out on top. It's performed exceedingly well. So once again, passive hands-off investors who are just buying the correct index are the winners. They tend to outperform. Now I love to look at the 2020 results because we know what's going to happen. However, nobody else does. So we understand that the world is going to be entering a very brand new investing environment, and that there's going to be a lot of excitement happening. Let's see how these funds have returned over that time period. And we see, with no surprise, VDY and XIU at the top of the list. The total market index, which is going to be very low risk because you're owning the entire market, is middle of the pack. and then ZW, or your dividend funds, your average dividend funds after underneath that, followed by mid cap, small cap, and covered call funds. Covered call funds are generally going to take a last place in terms of total return. All right, and now let's go directly up until March 1st. Seeing basically the same thing. Oh, actually, I take it back. Looking at from the, it's actually not a good time period to take it from. From the April, that's what I wanted. This is where the recovery is really going to start happening. After all the excitement, how did everything reset from that time period? And we see that XIU comes out on top. However, VDY is in second place with XEI, the S&P, I forget what index that is, but a very popular dividend fund coming in second place. Then we have small caps underneath there. Very surprising to see that. I haven't seen small caps catch up quite so much. However, it's encouraging to see them do that, and we especially see that small cap stock surging in 2020 and 2021 from when there was a lot of money flowing into the market. There was a lot of dollars just floating around the economy, both in Canada and America, really. Both of them went through some insane printing process during that time. And then as soon as that free money stopped, boom, then we see quite a bit of a dip as well. Where's that top point? March 2022. Yeah, so we had almost 2 years exactly of that, and then into contraction. This can be good for the people who invest in different market cycles. Again, unnecessary for the most part. Move this up to January of 2021. No real surprises here. Vanguard coming out on top, some very high dividend payers. XIU underneath that, and surprisingly, the covered call fund not in last place. Encouraging to see them catch up eventually. How long is that going to last? No, basically just one return period. So as soon as we started having that deep contraction of the market and things going, I should kick this up to March. Yeah. So as soon as things began reversing and things began to be normalized just a little bit more, and there wasn't as much money floating around, then we see XIU takes the lead again, followed by the total market index. Now, surprisingly, there is a mid cap and small cap inside of there as well, but yeah, XIU has been a solid winner. This is definitely a top fund for people looking for capital appreciation. We have seen it outperform time and time again over different contractions and expansion periods. And just over the past 1 year, yep, top of the list. So tied with XIC, which XIC has 6.5 versus XIU is 6.38, basically the same thing. And then mid and small cap under that, small cap trailing far behind, and ZWC actually, the covered call fund, outperforming XEI, the strict dividend fund over the past year. Makes sense, I suppose. 2023 has had some flat returns for a lot of XEI's holdings, which is very broad based and has some small caps inside there. Interesting. Although the biggest takeaway that we can take from this is the oldest ETF in the world, still a buy. Look, it's done well for people since 1999. It's literally the last century. If you had been a buy and hold investor, you would have performed exceedingly well. There's no reason to change your investment style now. Speaking of, taking a look at the share price over the past 20 years, we can see that even if you had bought at the very tippy top during the 2008 financial crisis, it would have about halved your investment down to the peak, or from peak to trough. However, if you were just holding, waiting and biding your time, if you had never dropped any more money into it, but it would have only been up until about 2015 for the entire share price to recover. You're still getting a good dividend during that time period, at least 3%. solid investment, and this is a fantastic time to dollar cost down, particularly into a low cost index fund like this. Similarly, taking a look at that 2020 excitement, going from $26, almost $27, down to 18, seeing $9 drop in price from peak to trough. Excellent time to buy in right there, and it did not take long for that price to come back as well. Everything, within a year had bounced back quite strongly. While we are approaching all-time highs again, the lesson to take away from this is that it's a good time to buy. The oldest ETF in the world is still a buy. And I just want to show the trading data on this, because the average trading volume is massive. We're like 2 million shares being traded every single day. This is largely going to be done by institutional investors, but is comforting for us that we know that we can always get in or out extremely quickly and extremely easily. Now finally, let's take a look at what some other people are saying about this. I do like to look at Yahoo Finance and just to see what some commenters are saying out there. David, this is in January of this year, says, I'm not seeing a dividend for XIU this month and haven't heard really any news. Is that a glitch? An investor who has not performed his due diligence. It pays out quarterly. So yeah, you'll be getting yours in February. Good reply, Bernard. Michael asks, when does the annual total return percent history get updated? I'm looking for this info and show my daughter how this ETF performed every year and wanted the 2023 summary. Dude, it's on the website. Check out the website, dude. It blows my mind how many people just can't perform a simple Google search. Alright, Mr. A says, XEI, XIU, VDY, which is better? Thanks. Okay. Now, Bernard, to answer your question, first off, XIU is probably your best total market fund if it's a best one to buy just as a buy and hold investment forever. Follow that up by VDY. VDY is going to take second place. It's done extremely well in the past, since its inception, and it is a very good dividend payer as well for anyone looking for dividends. XCI, I put in the second place, which actually means it's about fifth on the list, as I have 4 spots tied for the best dividend fund in Canada. So it's kind of low on the list. I don't recommend that people invest in this fund. I think there are far better options available. But Bernard says, I hold both XEI and XIU. So you're half right. This results in some duplication, but it also gives me exposure to 114 stocks, which is better, depends on many things. For me at 75 years old, I XEI for income. Not sure I agree with this investment strategy. I think that there's better ways of doing this. VCE, yeah, that would be another good option as well. I'm not sure that this guy is optimally managing his portfolio. If he needs income, it's very good to set up a portion of your portfolio strictly for that income so that you're able to budget and do whatever you need every single month. And then if you would like some supplementary income, you can either invest in dividends or a total market fund like this, as you will get some cash flow. And that far better than having cash sitting in the bank is having cash flow. Shop is literally 3 points of 6 points growing year to date. Long XIU and long Shop. So funny to read all the negative Shop comments. Oh, I guess. I'm not negative on Shopify. I'm just not a particular big holder of it myself. It's not something that I really buy into. If I am going to buy into tech, there are other options available. I'm going to have to get into QQC, the NASDAQ 100, and QQJR, the NASDAQ Next Gen 100 eventually, and do a comparison and contrast between those two, because those are good ways of investing in tech, which are very, very, very safe and have performed exceedingly well. Yeah, interesting. So People complaining about Shop right up there in May of 2023, and then get Shop out of this ETF, man. Jesus, says Maybach, down from 2022. This comment didn't age well. I agree. Shopify is half the gains year to date, May 2023. So this is why you would want to buy an index instead of being an individual investor. Dead illiquid market on the TSX. Either nobody wants cash or they cannot sell this thinly traded market. I'm not sure what you're talking about. Cyan bug. Perhaps it was low at some time, but trading volume is massive on this puppy. No one wants cashers. The market closed for 5 months. Not a single bid lot on stocks. Have zero in the open market. There's no auction. Okay. Untradable for day trading. What are you on about? Yeah, this is what I mean by lacking signs of intelligent life. This is a very popular fund, and we're going to give this guy a down vote because I don't know what you're on about. It seems like you're just typing random words, my friend. I didn't receive a dividend payment. There it is. Oh, what an idiot. Okay, is this all Canadian companies or does it have some US? It's called the TSX 60. I'm gonna say it's just Canada. It's going out on there. Going there. If only I could buy this ETF without Shopify. Until then, I'll buy the stocks individually. Yeah, I disagree with that entirely. Shopify would be included inside of the index for very specific reasons. I strongly disagree with that. Just let the ETF do its thing. All right. So now today we have taken a look. Oh my goodness gracious me. So today we have taken a look at XIU, the oldest ETF in the world, the S&P TSX 60. It is I put this as one of my top funds in Canada. It is an excellent way to invest in the Canadian economy. It pays out a 3% dividend. It is a solid investment, and it has such a strong running history. Over 25 years looking at it now of returns, we can see how well it's done. We can see how well it's performed with its low cost MER and massive assets under management. I see this fund performing extremely well now and into the future. It's the oldest ETF in the world is still a buy. Remember, I'm curious if you hold XIU yourself. I'd love to hear about it and what your own experiences have been, your own thoughts on it. Remember, if you are investing at all, you are doing far better than your contemporaries and you are ahead of the competition. Most people don't look at stuff like this, and they're certainly not, as we've seen from the Yahoo Conversations tab, they're very, very poor investors. We are not looking for average funds. We don't care about B funds. We don't care about C funds. We dislike E and F funds. We want A+ places to store our capital for a long time. Anywhere that we can just deposit it and walk away and know that we will be safe in the future and that we will have good returns. XIU is one of the best places to do that. I'm very happy to have it inside of my portfolio. It's not a major investment, as I do have a variety of other holdings. However, I like this one a lot. I definitely do invest in it myself. And I think that for anyone who is a collector of investment opportunities, that this one being the first publicly traded ETF is definitely something to hold inside of your portfolio, even just as a collector's item. And on that note, I wish you all the best. Keep investing. You are doing a fantastic job, and I'm proud of you. Keep going. Keep your head up. Keep investing. Keep going the grind. As difficult as it can be, that financial independence and that retirement is very, very attainable for us. We live in the future where investing has been solved, and I'm very, very happy to and excited about the future, and I sure hope that you feel some of that way as well. I'll catch you next time for another ETF review, and bye for now. My name is Matthew, and you're doing a fantastic job.